The Namibia Institute of Corporate Governance invites you to the next edition of Fireplace Conversations, focusing on shareholder dynamics on boards. Featuring Ms. Ali Angula and Mr. Daniel Motinga, this conversation will explore how shareholders influence governance through shareholder-appointed directors, shareholder expectations, annual general meeting resolutions, and instances where shareholders may interfere with or seek to override board decisions. Join host Edla Kaumbi for an engaging discussion on how boards can manage shareholder relationships responsibly. Be part of the conversation live on the NICG and the Namibian Facebook pages, or attend in person. To reserve your seat, contact 081 666 8645 or email training.events@nicg.org.na. Fireplace Conversations, proudly supported by 91 Namibia.
Good evening, ladies and gentlemen, and welcome to the NICG Fireplace Conversations. My name is Edla Kaumbi, the Executive Director at the NICG. Tonight, we are talking about shareholder dynamics on boards, when that shareholder activity strengthens boards and when it interferes or weakens it. This conversation is not just, we talk about it a lot with state-owned enterprises or public enterprises, but this is relevant even when we're talking about multinationals like First Rand, when we're talking about listed entities like Oryx, or of course, like we talk about our state-owned enterprises. But before we begin, we need to thank this partner who's made this possible, 91, one of the leading investment managers operating in Namibia and across the continent. Thank you so much for making this possible. They've sponsored every episode in the series, and this is the second last episode of the entire series. Thank you so much, 91. So let's get into it. Tonight, I have two guests, and between them, they have sat on both sides of the shareholder relationship as executives who've answered to shareholders and as board members who have had to manage shareholder expectations and sometimes making difficult decisions. Mr. Daniel Motinga is the Chief Executive Officer of RMB Namibia. He's bringing with him nearly 20 years of experience across commercial and investment banking, economic research, consulting, and advisory work, and a fellow FNB, former FNB for me. He became CEO of RMB Namibia in 2026, having previously led the firm's client segment business with responsibility for strategy, client engagement, and deal origination. His governance footprint is quite substantial. He serves as chairperson of NamPower, has been commissioner of the National Planning Commission Secretariat, and served as director of the Institute of Public Policy Research. Nice. He holds a Master's of Arts in Economics from the University of East Anglia and has completed the Senior Management Development Program at the Stellenbosch Business School. He brings to tonight's conversation the perspective of someone who thinks about institutions from the inside, who has sat at the board table of one of Namibia's most strategically important SOEs, and who operates daily in the world of investment banking, where shareholder relationships are the center of everything. Daniel, welcome.
Good evening. Thank you, Edla.
Yes. My second guest, one of the most credentialized governance practitioners in Namibia, I'd say. Ms. Ali Angula is a chartered accountant who became a partner at KPMG at the age of 26. Guys, your goals need to go up there. She spent decades since building one of the most remarkable board and governance portfolios in the country. She served as Accountant General and Head of the National Treasury at the Ministry of Finance, chaired the PPP Committee, and led the MTC IPO Steering Committee, producing Namibia's largest ever public listing. Her board career includes chairperson of NPTH, deputy chairperson of both NAMCO and Oryx Properties, board membership at Rossing Uranium, Old Mutual Life Assurance, the Bank of Namibia, where she was the youngest ever non-executive director appointed at age 35. You make us look bad, Ms. Ailey. And international board service with Nabo Capital in Kenya and Deep South Resources in Canada. Wow. She has chaired audit, risk, and compliance committees on virtually every board she has sat on. She is a World Economic Forum Young Global Leader and a Desmond Tutu Fellow. Okay, it's enough now. If anyone in this country understands what it means to navigate shareholder dynamics from the board table across private, public, and listed company, it's Ms. Ali Angula. Welcome. Thank you for coming.
Thank you so much for the invitation, and good evening.
Yes. So when King 4 talks about that the board is the primary governance custodian, it directs, it exercises oversight, and is accountable for outcomes. We talk about the 4 outcomes all the time, about ethical culture. We talk about good governance, good performance. We talk about legitimacy, and we talk about effective control. But the shareholder is not a passive participant. Shareholders, they are the ones who elect boards. They set mandates, and they hold boards accountable at AGMs. So in a well-governed organization, this is a good accountability measure. But the question is, when does it become shareholder interference? What is the difference between interference, activism, or empowerment? So this is what we're going to talk about tonight. So let us start with first principle. What is a shareholder actually entitled to do? Any one of you can start. Maybe ladies first. Yeah. When how a board runs, what is a shareholder actually entitled to do?
Okay. So generally, a shareholder has got principled entitlement on the appointment of the directors to the board, as well as setting what is their ownership requirements with regards to that entity where the board is, of course, in charge of in terms of strategic direction. So they would lay out what is their risk appetite, what are the almost like the go areas and the no-go areas. What are the red lines in terms of their investment? Because you're looking after their investment.
Right.
They would be entitled to they'll be entitled to approvals of major transactions. So if there is a disposal that needs to happen within the group, they'll be entitled to that approval because it's a major change of their business.
Yeah.
Where there is an acquisition, they'll be entitled to that. But what they are not entitled to, and I think that will probably be the center of a major of our discussion, is direct interference in terms of how that business is run on a day-to-day basis, because they've delegated that and they've basically given that mandate over to the board in terms of overall strategic direction and governance. And then the board then delegates that down to the management team and the executive team in terms of the day-to-day operations of that entity. So they cannot, they're not entitled to then go and get involved in the business. And they're also not entitled to those directors that they've nominated to say, this is the way that I want you to decide. And this is the way that I want you to carry yourself when you are making decisions and when you are voting on specific matters. They are not entitled to that, but they are certainly entitled to setting the parameters. What is their risk profile? What are the things that I would like to see happening in that business?
Yeah.
What are the performance matrices that I would like to see? And then, of course, the appointment of directors. Yeah.
Yeah. Is there anything you want to add to that?
No, Elias summarized it quite well. I think that the first principle obviously is from a value at risk perspective, shareholders have put equity down. So they have actual capital at risk. So that must be recognized, day one. I think I'm aligned with Ali. Day two, they have delegated them because obviously they are busy with many things. So clearly they said they don't want to be more involved with the day-to-day running. They do the running of the business plus the oversight function that the board provides. So I think they are entitled to obviously good outcomes being generated from that business because they so that there's rewards for the capital that they have put at risk.
So there are different kinds of shareholders, that we talked about. For example, we have shareholders like for FirstRand Namibia, they're multinational. They have a South African shareholder. You get listed companies like Oryx that we talked about that have institutional investors and the public. And then you have SOEs, that whose shareholder is government. What does that model feel like? Or what does the shareholder relationship, how does it feel different depending on the type of shareholder?
And it's an important distinction to make because they've got different outfits. And those different outfits make you to navigate that landscape quite differently for the three types. So for a multinational, and we can use RMB as an example, and then I can also bring in my experience with regards to Old Mutual, which is also not they're operating here, but they're a multinational. Rossing as well. At that time when I started on Rossing, it was owned by Rio Tinto, which is not a Namibian an entity, of course. And generally what would happen within a multinational setting is their expectations are codified. Yeah, the group would set expectations around performance, and it's clear, expectations around approval and how transactions are approved, expectations around what is permitted and what is not permitted, and it's very structured. Everything is standardized, everything is documented. You kind of know the path that you're going to walk, which for a local director acts almost as a good protection mechanism. However, what it doesn't do is, if you've got a very dynamic director, it kind of takes away a little bit of that, however much influence you can have on that board, because you've got a lot of things that are standardized and dictated by what the multinational would want to have. And I guess it helps in that in the sense that they would not only have an operation in Namibia, they would have an operation in multiple jurisdictions. And you'd want to have your businesses operating in a standard, well-known, documented way. So in that sense, it's much easier, I would almost say, to serve on a board of a multinational. But if you're a dynamic director, it can become really boring.
Yeah. Oh.
So there was So there was a point where I was serving on quite a number of boards, and the one decision that I had to make to free up my time and create bandwidth for myself was, which boards am I sitting on where I don't really have a direct impact on where this business is going? And the first ones that I got off were the multinationals, just because it's too standardized and what is expected is already set. So you would not expect an outside shareholder interference that is almost unexpected. It's very standardized, it's very clear, it's very well documented. Now, when it comes to a listed entity, and I've set on, you've mentioned Deep South, which is listed in Toronto, and I've sat on Oryx for quite a number of years, 11 years nearly. There you don't have direct shareholder interference or influence because that is governed by the listing environment. So you've got a diverse pool of shareholders. So you would have the institutional investors, which would have the bulk of the influence because they are the ones that spend the time, and they're the ones that go through the annual report, and they're the ones that pitch up at the AGMs. And then you've got the individual investor who is either their shares are held by a nominee company, they get the financials, they get the SENS announcements. So that's a way that you engage with them, is through the SENS announcements. And that's not a direct engagement. And then you engage with the institutional investors mostly, and then the proxies at the AGM. So the risk there is absence of direct shareholder involvement in that business versus those big block investors being the institutional investors. And then you've got our lovely babies, the SOEs. And I think for that, it's a very different kind of environment, and it's because it's a mixture of, you've got a shareholder who owns the shares in that SOE, and then you've got the same shareholder who makes the policy decisions, and then there's a mandate to each one of those SOEs that they need to carry out. And the SOE almost becomes an extension of the minister's authority to carry out the mandate. And that's where the lines really blur. Because once they've appointed you, it's very difficult, I guess, if I'm dictating policy, I'm also shareholder, and I also need to implement through this entity. It's very difficult to keep the boundaries in check. And that's where now you've got real interference, you know? So with multinationals, you've got the standardized way. This is the way that we do things, and this is our processes, our procedures, the objectives and the goals, and whatever it is that we are setting as targets are clear. Then you've got the listed institutions where you engage formally through the AGM, through the SENS announcements, and then through the proxies, and then the block investors, the bigger investors, the asset managers, the pension funds that do pitch up. But then you've got, absence of the other shareholders largely. And then with the SOEs, that's where you would have interference. And I think it's just because of the different outfits that the shareholder wears, because they're not just wearing the hat of a shareholder.
I hear it.
Yeah.
Okay. Daniel, can you add to that?
No, that's good discussion. I think so. So let's go back to first principles. So why did we start companies? If you look at the idea why people started companies is about risk sharing. So if you go back to, I think the first company is probably 11th century Italy. The idea was somebody wanted, in those days it was, you get spies in India or Arabia, you needed to get on a boat or a ship and get there. So there's quite a amount of risk involved. Sometimes the ship was owned by somebody else, and then the voyage needed the capital. So that's more or less how it started. So by virtue of a company being set up, I think there's that risk sharing component that is in there, and there's the agency bit where somebody is actually on the ship, taking the risk, operational risk, and making sure he or she brings back the voyage successfully. And then this side, there's somebody expecting a return. So that's more or less the domain. I think the next overlay that Ali also goodly mentioned is you must distinguish between then a fully entrenched company that is privately owned, privately held, versus a company that is listed, versus a company that is owned by the taxpayer as the ultimate owner. But again, at the core, all companies should behave the same.
All right. Okay.
But remember, a company is a legal person that can sue, go into contracts, and therefore, and that it expects certain things for agents that act on their behalf. So that, I think that we must be aligned on that. So therefore, I'm not on the page that when a company is owned privately versus when the company is owned by the taxpayer, the outcomes in terms of how they manage should be different. It should be the same in terms of the legal person's expectations about the delivery. So how do we experience it? I think in private companies, typically the unlisted, you would see, and you see that. I mean, if you open the Financial Mail, I was recently reading a story around Rainet Investments where they're sitting on a huge pile of cash, about 5 billion, and the shareholders in Rainet are saying, okay, this guy should distribute the cash to us because it's 5 billion euros. You can do other things with it, particularly when the share itself is underperforming. Obviously, the controlling shareholder, and that's where some voting rights, class of votes also matter, because sometimes you have a person that owns 20% of the business, but has 80% of the voting rights. And that can determine the outcomes, even at the AGM. Equity, I have value at risk of 20%, but 80% of the vote, and this is what happens in the business I have. So you find a bit of that in holders. Typically, founders protect themselves like that. In the listed space, I mean, as Alice says, it's easier. I mean, again, AGM is to approve financials, so review the financials and the budget for the next 2-3 years, and then the appointment of directors, when directors rotate. And obviously, in terms of the agency model, you must recognize that people have vested interest to almost select their own. No, it's not a good phrasing, but it's, if I am looking for a chair for audit committee, between the two of us, Ali is probably the better candidate as a CA. If you're looking for a strategy person, maybe long-term business development, then I'm probably the better person. So I think shareholders typically have, say, and they will be nudging. I mean, not directly influencing, but nudging the process that maybe, Ali for that committee, Daniel for maybe chairing the board. So that nudging happens. Now, how it happens is typically there's engagement. People can send signals, maybe through a coffee, and then, if the CEO, maybe what are your thoughts around, we a shorter director, what names do you have? And then it'll be a vetting process. In the SOE space, it is similar. I mean, now I think we know people are applying. Not everybody applies. So sometimes you have to nudge directors in terms of the skill sets that you want. The challenge, obviously, now, I mean, we were discussing that earlier or implying it earlier, is you need to, at any given time, for the interest of the company, attract the best directors and the best management. So to the extent that the shareholders are too intrusive in terms of proper outcomes for the business, you may find that the incentive for independent, critical directors will probably be a challenge. So you will probably have to, at some point, create a better balance between either being involved or devolving all the power to the director. Because it should be in the interest of the company, as a matter of principle, to have the best people looking after its affairs. I think that balance is probably where we are not getting full alignment.
Yeah. So how do we get that balance? I mean, because you mentioned that the companies should be the same because they're all company and because they have a mandate, whether it's a act of parliament that instituted it, or whether it's these shareholders got together, or these owners, founders got together. And you mentioned the nuance, the difference between when it's a state-owned enterprise or versus a listed company, and how in the different models. But what is ideal? What should it be? I know I'm going a little bit off the path, but what is ideal? What is best? Especially if we know that according to good governance, it's supposed to be in the best interest of the entity. But as an owner, I also want a return on my investment, So what would be the best in terms of shareholder activity?
Yeah.
Especially for state-owned enterprises, you know what I mean? Because I know there's reserved matters and they have generally the right way, but how do we do it with especially state-owned enterprises?
I think with state-owned enterprises, they are really, and they shouldn't be, because you've got state-owned enterprises that are registered in terms of the Companies Act. For instance, NAMPOWER is registered in terms of the Companies Act. You've got Transnameb that's also registered in terms of the Companies Act, and you've got some SOEs that have come about because of statute. Yeah. So they are statutory bodies, right, in terms of acts. But even that kind of making them slightly different. What you would want to have as a shareholder is you would always want to have the best outcome coming from that entity. You would want performance. You want delivery on mandate. But certainly when you've got a shareholder who might have a different definition of what delivery is, then you've got the real direct blurring of lines. And I think for SOEs we can get into a little bit more detail in sharing versus maybe a multinational or a private company. I'll use the example of when I sat on NPTH. So I was chairing the NPTH board. Of course, we had a mandate. Our mandate was to dismantle that entity. And then we had the great opportunity of being able to acquire the 34% shares of MTC. And then, of course, when we acquired those 34% shares of MTC, we couldn't hold on to them, because then it made us this monopoly within the telco space, because NPTH owned 100% shares of Telecom, and we owned 66% shares of MTC. And from Competition Commission's point of view, now we would own 100% of MTC and 100% of Telecom, and it was a no-go. So we then saw a path to a listing, right? But even that path to a listing, I mean, we've got a great asset. We've got probably a great example between where you would have state interference within the running of Telecom, and we know where Telecom is now in terms of service delivery. But we had this great story in terms of MTC where we didn't have as much interference. Although it was all sitting under MPTH, we didn't have as much direct interference from shareholder. But that kind of changed the moment when we had the 100% shares, and just going through that path of the purchase and the path of the listing. And we could then see the direct almost conflict of what the then line shareholder minister wanted to accomplish. So we know that we've got a vast country, right? So, and in terms of telecommunication, he's minister of MICT. He wanted 100% population coverage in terms of access to telecommunications. You've got a great asset that you now must list to make sure that you are not a monopoly, right? So you cannot be destroying value on your way to a listing. So the moment you're giving me a task to give you 100% population coverage through this entity, and I must deliver value to shareholders that are not just you anymore. When it was just you, it was okay for you to say, I can forego my dividends coming from this entity, and then I can invest in public assets and public infrastructure. But now when I'm on the way to a listing, allow me to create that value without the interference, because now there's other players. So now here comes the conflict. Policy is to deliver telecommunication services. So in his thinking, there's actually nothing wrong from a policy point of view. But where you've appointed me as a director, my fiduciary duty is to make sure that financial performance, I've got financial performance, because this is a PTY. It's not a statutory body with just a mandate of providing telecommunication services. So then it becomes difficult to find that balance, right? And that is where you would find yourself with a lot of this SOEs, because you've got a public mandate to deliver infrastructure, but you have set up this entity for efficiency purposes in either as a PTY or as a limited entity, and now you've got this governance structure that you need to navigate, that you also yourself as a policymaker don't understand too well. So finding that balance is hard.
Yeah, because I mean that's a legitimate thing, and I mean that is not just in that case of the the telecommunication space, but I'm sure there are other such examples where the shareholder has one idea and those who are appointed to run the organization have maybe another idea, and I think they are both legitimate. Actually, I'm thinking from my ethics perspective, in terms of. So I would love to hear what the audience thinks, and those who are watching, maybe put in your comments what your thoughts are, and Daniel, what you want to put, and because it leads into the next questions as well, in terms of it doesn't matter who's appointed. At the end of the day, it is about whether a shareholder appointed you or whatever. It's about the best interest of the entity. But now even this sounds like might both be for the best interest of the entity, maybe not in terms of sustainability, but in terms of it achieving its mandate. What are your thoughts?
So no, interesting. I mean, good discussion. But again, I mean, recent examples of listed entities where there is, because remember, in a business, it's like me and my farm. I'm here most of the time in Windhoek. The farm is 400 kilometers away. On an 8-to-5 basis, I don't know what's happening. If the guys are smoking a dachazol or, maybe slaughtering a goat. So there's a bit of that between insiders and outsiders when you run a business. Take the extreme example of bad governance, Steinhoff International, where there's a shareholder, but also not dominant shareholder, because the majority shareholders are outside, but an insider with certain different ideas in terms of what is good for the company. So the focus and the tension that you typically find in most businesses, even in the first rank construct, when you debate as executives, is, are you building out the business for the future? So you're saying, okay, this business has been here for 100 years, would be here for another. So in a sense, there must be incentive for management to plant trees today, knowing that he or she will not sit under the shade of those trees. And then that's the balance. And sometimes shareholders, particularly when you're a listed entity, maybe shareholders a pension fund, maybe JPF, and their stakeholders needs annuity. So they need to see upside, strong upside. So sometimes maybe the incentive for a long-term story is not prudent. But it's prudent for the business. If you say you rather have a 8% dividend yield for 100 years as opposed to 15, 20, 30, and then a zero. So I think that's the tension in terms of the value creation pipeline that typically handles. I think the rudimentary one for SOEs is probably we haven't, because of this implied tension that you have this social delivery businesses, business path. Any business will always need capital. External capital. So equity needs to be matched with bank funding, debt, to augment the trajectory of delivery. So when you have to raise non-voting people's money into your business, the only thing that they can look at legitimately is your financials. And if your financials don't stack up, there is no story. And that, I think, the incentive will be for the taxpayer-owned businesses, long-term. I mean, I bank them on a day-to-day basis. But is that its financial performance is number one, because the shareholder will be constrained at some point to put in capital. And we see a lot of that. I mean, there's lots of cases where the shareholder is constrained now. I mean, the sovereign, for example, as a proxy for the taxpayer. So I think it's and that's why I go back to my earlier point around, it's in the interest of the agents running the business to solve for the long-term sustainability of the business. It's because that's what the company requires as a legal entity. Because I tell the joke that, if my farm was running itself, it probably wouldn't have a Land Cruiser 4x4 4-liter V6.
Right.
Because that's not efficient. It's not fully efficient. I mean, so I think it's that there's a bit of that of business. So the trajectory of the conversation is, how do we make entities at the core financially sustainable. Because there to, I mean, take the example of NPTH, the contrasting. If the institution is financially sound and you can tell the shareholder, I'll deliver X maybe in 3 years, but the broader mandate, social mandate around 100% coverage, we can do that in a 7-year window. Because then I will have done this ABC. I think that kind of conversation, when the shareholder doesn't have that appetite for that strategic conversations, you have problems.
Yeah.
Then you must actually shut the company down.
Yeah. Because that's what I want to ask though, right? Because I don't think the issue is that, I think everyone wants the financial sustainability of the organization. Everybody wants it to succeed, but how we see that succeed and maybe it looks different. And maybe that's the issue in terms of the shareholder wants returns, they want the company to thrive, but how they see that happening might be different to you as the director who's actively overseeing the organization. And I guess maybe the conversation for tonight is how do we navigate that conversation? Because I mean, there are different ways. How does that conversation happen between the shareholders and the board? You did mention earlier, but maybe unpack that a little bit more because we are talking about shareholder dynamics on boards. So what would that look like, especially for what you talked about? How should it happen?
So ideally, you would want to have a shareholder with very clear expectations in terms of performance, right?
Mm-hmm.
And once those expectations are clear, you can then say to the director that you're appointing, these are my expectations in terms of financial performance. These are my expectations in terms of what my risk appetite is. These are the red lines. These are the things that I would not even be open to discussing. And then along the way, and I will reference back to this MTC one because that one I think is a good example. Along the way, I would then say as a shareholder minister, I've got a mandate to deliver this type of service. So within this years that we've got, and the board's terms are now 3 years, right? So within this 3-year term, and they've got a 5-year term. So you'd hope that it overlaps, their term overlaps with yours, right? And that you don't have kind of an outgoing minister who hasn't delivered and then they'll be pushing you to deliver. Then it will be an even bigger contention. But to then say within this period, I would like to see coverage of telecommunication services over this area. How do we achieve that together, right? Because you've got the day-to-day knowledge in terms of the numbers around this business, because I've given you a mandate as a director, I've given you a responsibility, right? So how do we achieve that? And if you as the shareholder are then willing to trust that you've appointed the right person into that position and listen to what that person is saying to you, we can ultimately meet that objective. Right. So I can still comfortably sit back and say, I'm going to deliver a good financial performance to you. And then I will still deliver on what you would need to be done in terms of the infrastructure mandate. But this is the way that we are going to do it. Right. And hopefully you've got a shareholder minister who is able to listen to that and also be patient enough for that to be delivered on. And in some instances, you don't have ministers that are patient enough because they've got other pressures that you are not even privy to, whatever those political pressures are, right? I'm glad in the end, it led to me exiting NPTH because of just the amount of interference on that board. But what I'm glad about is once that listing was done, once those shares were bought, we've delivered a return in excess of 10 billion to state just from that one transaction. And that is just because we really just said, we're going to do this and we're not going to do anything that is going to destroy value on our way there. So now if you look at, the budget for government and you look at revenue that is non-tax related, MTC's dividend or NPTH's dividend, because it's coming through NPTH, which is now really finally now in its dismantling, outweighs the return that is even coming from the mining sector. Wow. in terms of the shares that government owns in like NAMDEP. So if you sit back and you're like, okay, we did the right thing because we just focused on what is the right thing for the entity. But I think in terms of kind of what are the options to get to an outcome that works for both parties is if that conversation can be held in such a way that says, we can attain what you want to attain, but let's do that in a financially responsible way, such that we still will have an asset that can deliver not just today, but 3 years' time, you might also want towers somewhere. And because we've protected this financial status of this entity, we can give you those, you know?
And when we decide on this, when we agree on this, to then let the board run.
Yes.
Yeah.
No, aligned. I mean, so remember, it's like part of life. There'll always be tension. Marriage life, children, parents, they'll always, but at some level, there's somebody that needs to make the final call. But in terms of the alignment piece, I think what is clear is that, in my mind, at least, even when I was on the non-power board, you'd see, I think the tension arose, climax probably when you say we have to switch off the lights. And I as the chair, had the understanding that, that obviously politically it's not an easy thing to do, even for the company. I mean, even if we had a different shareholder, it'd be sort of, but for the company, to use my earlier analogy around the Land Cruiser, it's in the industry of company that say, if you want to do business with me, but you're not honoring your commitments, I must cut the relationship so that maybe you collect firewood. It's not easy, but that's in the industry of the company.
Yeah.
And it's a fine line. So you typically, in that conversation, you'd say, okay, but if you are saying I shouldn't cut the lights, you must make me good on the numbers. If you're not able to make me good on the numbers, then I must look at my customer and say we are alienating the relationship. So those kind of things is normal. So for me, I don't lose sleep to have that kind of conversation where you're a first-run shareholder or government shareholder. Because remember, what we bring as directors is our reputations. Okay? So you say, okay, people should have the option to say, okay, up to this point, I'll probably have to survey the relationship, whether it's a private company, public company. And it's about the ethical piece. It's about, value systems. And so people like me typically don't have the political. I'm not a politician. I'm a businessman. I'm a farmer. So maybe the temperament is slightly different. But I think the alignment, the key thing is on the numbers of the business. If you want to make the business sustainable, you need to run it to business principles. And the challenge now that I see, I'm now 52 years old, so slightly older than probably half the cabinet, is that most of the people haven't run a business. And maybe the regression that has taken place now is in the old construct, we try to capacitate, this Ministry of Public Enterprises, and people are building up the capacity to, how do you run like a business, what's in the interest of the Business Companies Act. Now we have reverted back to this thing where ministers, who are sometimes not technically able to understand the numbers, the complexity of the business, the environment in which some of these are the final decision makers. And that's unfortunate. But it's so complicated. Companies will shut down. Yes, companies will disappear. And that's the unforgiving part about business. Whether you're state-owned or public sector-owned or privately owned by a billionaire, if you're not run properly, you will disappear. Somebody will provide that service. We have seen it in SA Construct, where ESCOM was not able to come up because of the political pressures like that the dumb power has. And private sector is providing those services. I mean, if I visit my colleagues in SA, you would see everybody has a generator, a solar system, a battery system, a borehole drilled into the house because so people will solve. And as people solve, you will be displaced in terms of your mandate. So that's critical.
Sure. It's really scary. So what should directors do then if they get an instruction, whether it's not maybe an unlawful one or one that we're seeing as maybe not viable for the business from a shareholder? How do we advise? What is the best?
No.
And the consequences.
It's not complicated.
It's not.
And you say no.
There are consequences. There are real consequences.
You say no, and you have the right to leave the door. If somebody says, remember, it's not. I mean, in terms of the company, I mean, there's case law. I mean, there's NICG. I think one director that actually took a shareholder to court, if I recollect the facts correct, and won.
Yeah.
So I think there's legal precedents where a director says, I have decided in the interest of the business, in terms of financial responsibilities, that was the right call. The law is in your favor. So if you do the right thing, I mean, that's true for life. The facts of the law will be in your favor. So maybe people's economics environments are different.
Yeah, exactly.
But ideally, if people need the board fees to be there, you probably don't want them on the board.
This is
If
true.
board fees is critical, because remember, how will this person
Be
make long-term
independent,
decisions?
100%.
If the long-term decision is that Daniel has to forego his board fees, maybe for half a year, or in fact go and borrow to get the risk alignment as a director, maybe go and borrow, put money on the table to sustain the business. So that's typically, so it's all about, I started earlier on the risk sharing bit. If you're not if you have nothing to lose, then you make these calls of firing maybe the whole directors. But if you have something to lose, you would actually have to think twice around your decisions. And maybe ministers should be, as part of the new construct, take a bond on their houses and put $1 million in the companies that they run. So they have something to lose for bad decisions. I think that's the alignment piece that is critical for me.
I like this. Do we have any comments before I move on, comments from the audience? We have a few people here. Maybe online. Do we have a question on? No, nothing online. Okay. No questions, comments? Yeah? Okay. So maybe, Danielle, I wanted to ask you, in listed companies, the AGM is the primary formal mechanism through which shareholders exercise their power, voting on board appointments, approving remuneration policies, asking questions. Maybe how do you think, how effective is this AGM process as a governance tool?
So it's effective today in the sense that, people show up, the financials are there, the management is there, the chair, the board is there. But people don't show up. I remember I used to have a few shares in Bidvest one time, even in first round when they boosted when I left. And I went to the AGM. People were actually, we're only two. Besides the board and the chair, we're only two shareholders at the AGM. Even at Bidvest, we're only 5 at the AGM. So I think because most of the shares are held by asset managers, professional managers, I mean, they probably tick the paper in terms of the resolution and then let it slide. But so in Namibia, I think there's work to be done around shareholders coming to AGMs, keeping directors accountable. I think that is key. In SA, it's interesting that there's even asset managers are much more activist. You would see recently, I think in June, where APSA had to vote on the reward for CEOs. And 40% or slightly more voted against the resolution. And then the threshold is if 25% of the director or shareholders dissent on a particular matter, then board is forced to meet that shareholder and negotiate. So in SA, there's kind of examples where shareholders can actually say, no, we don't like what management is proposing. They're enriching themselves potentially. I'm not saying APSA enrich themselves, but people are saying, this particular gentleman moved from Standard to APSA, and maybe the settlement, because obviously he had to forgo some of the rights options that he had in Standard Bank, maybe the upfront reward for the risk that he's taking, because he hasn't delivered anything here, is probably too high. I think the processes allow for shareholders to keep board of directors in that sense accountable. Say, guys, you are destroying value. You are not doing the right deal that is in the interest of the company. So I think there's definitely room for growth in Namibia. We can do more. People are passive. Part of the challenge also, remember our stock exchange is people buy to hold. So trading is limited. So if I've been a shareholder for 10 years in FNB Namibia or first round Namibia shares, I know this company is a bank, it does well. If there's a bad story, it will be in the newspaper. Maybe I don't need it. But I think I can see opportunity where shareholders, boards of directors, and management can benefit from that interaction.
Did you want to add anything?
Yeah, I think there's one AGM that always used to be very alive, and it used to be when NBL.
Oh.
Yes.
So you would find the shareholders, or we assumed initially it was like a room full of shareholders because I used to sign off the NBL financials. But we later found out it was just before SAB Miller set up the plant in Okahanja. So they would basically send their people in, because an AGM is open, right?
Yes.
So they will send their people to come to the AGM and hear what are the strategic intents and the plans for MBL.
My God.
And that's really the only AGM that was pretty active, but the other AGMs are pretty passive. I know on Oryx we would have the majority of our investors there, but of course you've got the individual investors that are held through nominee companies, and you would not see those individual investors. But the institutional investors are quite active, but there is a lot of room of improvement in terms of kind of this investor activism that is very alive in South Africa that we don't have here.
Yeah, because that brings me to that question about the institutional investors like pension funds, asset managers. You know, they have a lot of influence, like you say, and and you mentioned earlier about, you know, keeping organizations accountable and so on. So what are we in Namibia? Are we using that influence? I think you mentioned maybe not so much. Are they using that influence? Should they be doing more in terms of calling organizations higher or bringing them up to standards in terms of good governance and so on? I mean, we're talking now positive in shareholder influence.
So what do we see? I mean, in the boardroom is particularly asset managers to allocate pension funds money. They're obviously looking for return, higher return, long-term sustainable return. So you can see them pushing businesses around cost, around the proper story, around long-term growth. So those kind of pushbacks are happening. But I haven't picked up where they say, okay, I don't like that director that you have nominated, we'll vote against it. Maybe, obviously, now maybe a small, people know each other, so we know, I mean, maybe talent is constrained. So there's definitely opportunity around, I mean, take a theme around sustainability, ESG. There's a key theme. Globally, people vote around those lines. Obviously, I think there's a realization in some boardrooms, I mean, BlackRock, or one of them experienced this challenge that maybe the returns are much more better in the non-ESG economy, so you need to strike that balance. But it's good to put it out there so that you test the shareholders' appetite for these things. Maybe shareholder says, you know, you must all go green, and then they realize, okay, maybe you must do a bit of oil because the returns are much better. So there's definitely opportunity for alignment, for growth. And as I said, I mean, sitting on the side of management, we would appreciate that those discussions, that feedback is critical for us.
Look, for an AGM, it is the right place in terms of where shareholders would engage you. We had an interesting outcome at an AGM. So previously at our Oryx AGMs, it will be, you know, we'll put forward the agenda items that needed to be voted on. And you know how your votes are kind of standard every year. You've got unissued shares. Do you approve for the directors to have the right to do with those shares as you would want? And for our shareholders, it was always no. There was always the one item that got voted as we never got majority for that vote. And then it was, you know, the annual appointment of the rotation of directors, and then the appointment of the auditors. But there was one particular year where we did actually put a substantive item to the shareholders. And it was just around COVID, because now it's a property fund. We've got tenants that are affected. We've got within the portfolio industrial sites. We've got within the portfolio hotels, and of course during COVID you didn't have people that were traveling. Yeah. And we had in our trust deed that we would declare 90% of every of the return, right? 90% of that return, it was baked into the trust deed that we would declare that out as a dividend, as a return to the shareholders. But we realized during COVID, we needed to bring that down to 75% so that we could create a cash buffer within the business. When we brought that matter to the shareholders, we really had a very lively AGM. Because you've got the institutional investors that are saying, but I need this return if I don't get this return, then I could just as well be parking my shares in another property fund, and I don't have to do extra work. So if you've got investors, especially the institutional ones, that are very key on whatever that return is that they need to give back to either the pension fund or to their ultimate shareholders. When you touch their income and you touch their return, then they are super active at the AGMs. But if it's just a standard kind of run-of-the-mill kind of AGM, then there's no excitement there really.
That's a good example.
Yeah.
I mean, I remember one listed entity, I'll not mention the name, mining entity many years ago, forgo. I mean, similar. I mean, the CEO made huge investments. Some of the investments didn't realize, so therefore there's a capital constraint, and the business, they couldn't pay a dividend. So there's a big uproar. I think she didn't last in the job. So it happens. So when shareholders say, I've carried you and there's no upside for me, they can vote you out. So you can even lose your job as a CEO.
Yeah. Well, it makes sense. I mean, it's the interest, right? But let's look at what does good look like. If you could design like an ideal shareholder board relationship, one that creates genuine accountability without compromising board independence, what would that look like? What are 2 or 3 things that would have to be true for that to work well?
I think the first one, and at the risk of repeating myself, I think the first one is alignment around the purpose of the business. Okay, so why did you set this up? Okay, why did you set this up? To make maybe a broad thing is to make a difference in people's lives. Like Facebook when it's set up. I mean, there's no clear profit motive initially. As you're looking at the business case. We realized, okay, they're actually in the end using adverts to pay for the business, and it is going to be a valuable business. So it's that alignment around what is the purpose of this business, and then how will we measure it? And then I think the thing is around financials on time, because you would see most of the businesses struggle with audited financials on time. Obviously, there's capacity issues in them, but so those are the 2 things around purpose and the measurement of financial metrics. That would be critical.
Yeah. What would you say?
Yeah, I mean that piece around clarity on purpose of purpose is super important because it drives alignment. So once you've got alignment with whoever is nominating that board member, and being the shareholder, and the director around these, this is my risk appetite. These are my red lines. These are my performance expectations. Then trust me as the person that you've appointed onto that board to carry that out, because we are aligned in terms of what is driving you and what drove you to start this business. And then I can carry out my fiduciary duty to this entity so it can deliver on what your expectations are. I think it's also important that there should be an expectation that although you have either nominated me on the board or you appointed me on the board, you've appointed me for a reason, right? Allow me to do my job. And therefore, they should, if they...
That's what that reason was, though. Right.
Because you in some instances, you won't know. So back to perhaps an earlier point that we discussed around when the directors are appointed onto SOEs, for instance. You could be appointed and you are a professional in your own right. Your reputation is important to you. You're driving performance of this entity, and that's your expectation. But then you've got 2 or 3 other directors that were not appointed for that purpose, right? And there was no discussion around why you're being appointed. You're just being appointed onto a board. Income is good. You don't have to read your board minutes or your board pack. But there's a reason why they put you there. And at some point, that reason will come out because you will get a call. So there must be clarity in terms of whatever those expectations are. And ideally, perhaps a conversation around if there is something that where your input is required as shareholder or appointing authority or whatever your position is, whatever discussions we are having and that input, let that input come in writing.
Yeah, I wanted to get to that.
Yeah.
In,
Because if it's in writing, and a lot of this kind of interference and where you are not able to hold somebody to account happens because a lot of the interference happens very informally. You know, it's a call that you get, Madam Chair, I know that this is what is on the agenda for the meeting today. And you're like, okay, how do you know what is on my agenda for my meeting today? I know this is what you guys are going to be discussing. Can this be the direction that we are going? And that is a call. Nobody ever they don't put anything in writing. So for the tension to be managed, and there will always be tension, life is like that. There's always a good side and there's always a bad side to anything in life, right? But for that tension to be managed and that relationship to be managed and for it to deliver the outcome that you would want and the output that you would want, your input, when it comes, let that input be in writing. Write me a memo and say, this is what my views are on that particular transaction that I know you guys are going to be discussing. But the informality kind of breeds the ground for the contamination of the governance environment. So for formality around communication, formality of inputs from anybody that is not on the board where they want their voice to be heard, resolutions, AGM resolutions, whatever it is, just put it in writing, let it be a resolution. Agreement in terms of purpose, what are my expectations, what do I expect in terms of how I want my business to be carried and the return that I want from that business. And then an expectation that there will be a difference in opinion. We are human beings. Just as different as all my fingers are, it's on one hand, but my fingers are different, right? So that difference becomes even bigger when I'm dealing with another human being. And because I expect that there's going to be a difference, I should be clear to say, you are appointing me on this board. We will have differences. Can those differences come without consequence so that I am able to carry out my fiduciary duty without being scared of you and the repercussions? Yeah. I'm like Daniel in terms of a business is supposed to be run a certain way. And also if something is not done in the right way, my answer then was always, it's a no, right? But to that, there's always a consequence.
Yeah.
So, and I think that discussion, for that relationship to work out well, that discussion should happen before that relationship even starts. So that the appointing authority, being a minister or whoever it is, knows that we will have differences. And when we have differences, can we not make it, what's the right word? The consequences must not outweigh the benefit that I've delivered to that business. Or else we'll always have the person that values their reputation staying away from boards that actually need that talent. They need that talent. Yeah. So for me, it's formal documentation of input, clarity around purpose and expectations, and then just this discussion beforehand to say we are going to have differences. How are we going to handle those differences when we get there?
Yeah. No, I like that. And I like that you're saying formal communication, but I believe there are also proper channels to do this. I mean, we're talking about the AGM, but the AGM is just the floor, I mean, surely, it's not just one, AGM. You're supposed to have general meetings that happen. I think maybe clarity around that as well, so that we know. And you're talking about written communication, about purpose, and about how we measure the outcomes of this. So I believe those should be formally documented as well. That's what's supposed to be in place, whether, we call them, am I cut off? Whether we're talking about, reserved matters, where, what is like role clarity. Yeah. When does the shareholder have the right to intervene, not intervene because these matters are reserved for them, and what is reserved for the board. Likewise, the board not intervening with management because this is what's reserved. So proper delegations of authority. Yeah. So I like what you guys are saying. Yeah. Do we have thoughts, comments? Looks like we have something online.
Yes, we have Phenomena Feni, Mefeni Nyekevali. At what point does the passive shareholder become a governance risk rather than remaining silent or sleeping shareholder?
I think that's what we talked about earlier about institutional investors and the responsibility they have in terms of holding organizations accountable. Do you have any thoughts?
No, I think so. If a business is doing well, probably
Yeah,
the incentive to be around is probably limited.
right.
But if the business is going astray, I think the passive shareholder, it's in the interest of the shareholder
Yeah.
to come through and say, okay, what's happening here? Do you need more capital, or you have lost direction? You're not running the business. So I think it's only good to be passive when the business is well run and things are good. But you need, even when the business is well run, I think it's your interest to review the management reports, to review, the annual financial statements, the interim updates, if it's a listed business, updates that the business coming through, and how the peers in that group is doing. Because you also want to keep the business owners around. If there's a telco that delivers X in a similar market conditions, then if Daniel runs a different telco that delivers Y, you should be able to say, but Daniel, why you're not able to match those numbers? So I think there's always an opportunity for shareholder to keep management honest.
Yeah, it's time to land this plane. I really love the conversation, and I hope that there's more clarity around this, because it's not, there's not a problem for shareholders to shareholder activism or to engage boards. It's how we do it. That there must be clarity with regards to who's responsible for what, and that there are formal channels for them to communicate, and they should be clear and formal. Like I said, what can they do, what can they not do. Likewise with board and executive management. So we shouldn't villainize, shareholder activity, but then they should be clear. It should be clear and it should be understood, because they're actually keeping the boards accountable, just like the boards keep executive management accountable. But before I conclude, I'm pleased to share that the NICG, we have been invited to participate in the Africa State-Owned Enterprises Corporate Governance Summit, and it's happening in Maseru in Lesotho at the Avani Maseru Hotel. So I'm honored to be contributing to the summit as a speaker alongside with other governance leaders and practitioners from across the continent, as we engage in important conversations on strengthening the governance of performance of state-owned enterprises. So on behalf of the NICG, I would like to express our appreciation to ICS Africa and the Institute of Directors in Lesotho for the invitation. And so we are inviting and encouraging, state-owned enterprises in Namibia to participate, to register, go see the Kingdom of Lesotho, maybe experience a little bit of snow. So for further information, please do contact us. Contact us at info@nicg.org.na to register, to get more information. There might be an incentive there for you. Do contact us and we will let you know. And that's all from us. At any final 30-second words, closures, summaries,
No. Thanks for the NSCG for having me. You guys have been nudging, and I've always been saying no. So it is good to come. So it is good to be here. I think the next phase of the conversation is if we are constrained in the way SOEs are delivering, maybe we must change shareholders. That's a thought. Thank you.
Okay.
I like that thought, and it's actually something that I had a conversation with someone to say, when you're getting ready for a listing, you clean up a lot of stuff, and there's been a lot of pull on the treasury with regards to all the subsidies that are going to SOEs and statutory bodies. So what if you go to the market and ask for that money? Because the market is going to ask you to perform different and act different. You don't have to change your mandate. You just need to have a performance story. And then the rest will leave up to the regulations of the NSX. And your posture will be totally different.
Yeah.
But the question is whether do we want to enter an era of performance? Do we want to enter an era of delivery, or do we want to continue with the status quo?
Governance, good governance wants all four of those outcomes. We want legitimacy, public trust. We want good performance. So whatever the purpose of the entity is, we want ethical culture. So we want, people with upright characters.
Yeah.
And then we want effective control. So we don't hemorrhage money, or we don't, So I don't think it's one versus the other. And so maybe if the interest is really in terms of overall good for our economy and our citizens, then maybe that should be the interest. So shots fired. I hope somebody's listening. Again, we have to thank 91, one of the leading investment managers in this country and the continent. Thank you so much for your support in making this possible. Thank you to the audience and those who are online. Thank you so much, distinguished guests.
Thank you.
What a
Thank you.
lively
Thank
and
you, thank
meaningful
you.
conversation. Thank you so much. And good night. See you on the 20th, everyone. All right.
That brings us to the end of this edition of Fireplace Conversations by the Namibia Institute of Corporate Governance. Thank you to our guests, Ms. Ali Angula, Mr. Daniel Motinga, and host Edla Kaumbi, as well as to everyone who joined us for this important discussion on shareholder dynamics on boards. Join us for our last Fireplace Conversations on the 20th